Hello, and welcome to the second half of the Fundamentals of Financial Accounting course. Before we proceed into Chapter 6, I would like to remind you to download the blank file so you may fill it in as we proceed through the chapter. Chapter 6 is all about inventory costing methods. So you see a couple of formulas here right off the bat. The value of ending inventory is equal to the number of units on hand times the unit cost. So this is the cost of each unit. The cost of goods sold during a period is the number of units sold during that period times the unit cost. How do we determine unit cost? We take purchase price and subtract off purchase discounts and quantity discounts, and we add in all the other necessary costs to bring this unit to a sellable condition. So this would include things like freight in, duties, insurance, storage, etc., etc., etc. So let's start off by looking at That's a Few Bookstores perpetual inventory record. So we have 4 columns across the top. The first one is simply the date, and then on certain days, the bookstore will purchase a certain number of textbooks. On other days, the bookstore will sell a certain number of textbooks. And the last column here, quantity on hand, is a tracking column where we're tracking the number of books we have on any given day. So on September 1st, the start of the reporting period, which is the month of September, we have 15 textbooks on hand. And on September 4th, we have our first transaction of the month, and we have a purchase of 13 textbooks. So what we'll do is we'll update our last column here with the updated number of books, 15 on hand before this first transaction, plus 13 more purchased gives us 28 on hand. This is a pretty straightforward process. So on September 10th, our next transaction happens. We sell half our books. 14 are gone, which leaves us with 14 left. September 13th, we have another purchase. We don't want low stock here. So we have 29, 14 plus 15 new purchased. And on September 20th, we sell 12, so we're down to 17. And the very last row is the totals row, where we add up the numbers for the month. So, for example, if we look over here, this is giving us the total number of textbooks we purchased during the month. We purchased 13 on September 4th, 15 on September 13th. Therefore, we have a total number of 28 books purchased during the month of September. Now let's do the same thing for quantity sold. We had 14 in our initial sale, and we sold 12 more. Therefore, we have 26 total sales for the month. And finally, the last column, quantity on hand. This is not a total column. This is rather a tracking column, as I mentioned at the start of this exercise. So you're just pulling down the final number, one box below, to report your ending inventory for the month of September. So we had 17 on September 20th. Nothing else happened. So we still have 17 on September 30th. The bookstores cost per textbook is $50, which is comprised of a $40 purchase price plus $7.50 for shipping and $2.50 for insurance. Therefore, our ending inventory and COGS calculations are as follows. So what's happening here is we're using the information from the table above, which we just completed, to determine the ending inventory value in dollars and also the cost of goods sold value in dollars. So take a minute to try these two calculations and we will continue in the same video. So at the end of the month, we had 17 units on hand and the unit cost is given to you as $50 per unit. So 17 times 50 gives us an ending inventory value of $850. Moving on to COGS, we sold a total of 26 units in September, and the cost per unit is once again $50, which gives us an ending COGS value of $1,300. 26 units sold at a cost of $50 per unit equals $1,300 of cost of goods sold in September. It was a pretty straightforward calculation since the unit cost was kept constant. In reality, prices do change in the middle of a year, quarter, or month. Hence, we need costing methods to assign unit costs. The following methods are permitted under ASPE. So 1. Specific unit cost. 2. Weighted average. And 3. First in, first out, also known as FIFO. The specific unit cost method uses the specific cost of each unit in inventory for items which have a distinctive identity. For example, this would work well for used cars. A lot manager can easily keep track of how much each car was purchased for, the cost of the work done on it, and the cost incurred in effort to sell it. This method is much too costly and inefficient for inventory like juice boxes or toy cars. So specific unit is very straightforward. Basically, you're just tracking each item and how much money you spend on it. Weighted average cost method uses the average cost of the period for an item unit cost. The cost of the inventory is updated after each new purchase. For example, if a business had 10 units which had cost $4 each and purchased 10 new units for $4.50 each, the weighted average cost per unit would be $4.25. This concept is explained in detail below. So let's talk a little bit about this example here. Because we have exactly the same number on hand and exactly the same number that were purchased, 10 and 10, we can calculate the average easily as the number that's right in the middle. So our weighted average was 4 before the new transaction, and then when we purchased 10 new items at 450 each, it pushed the weighted average to exactly the middle point of 425. First in, first out, or FIFO. The cost of goods sold expense is based on the oldest purchases. This method assumes that the oldest inventory is moved out first. Under the scenario above, the first unit sold from the inventory would have a $4 cost, and the one sold later would have a $4.50 cost. So even though this might not be the reality, where a customer might pick up a new item which you bought more recently, we assume that the oldest inventory moves out first. And in practice, that's a pretty accurate statement. A store would typically tend to put older items on the shelves and wait for them to run out before the new ones are brought out from the back. You don't want things sitting around for too long. Inventory costing in a perpetual system. The inventory costing methods produce different amounts for ending inventory and cost of goods sold. So jumping into moving weighted average first. With this method, the business computes a new weighted average cost per unit after each purchase. Remember that we're talking about purchases. In the event of a sale, the moving weighted average doesn't change. The average unit cost is rounded to the nearest cent and the total cost to the nearest dollar. So because the unit cost is used for other calculations, we retain some extra accuracy by rounding to the nearest cent. Meanwhile, the total cost items, such as ending inventory and cost of goods sold, are typically used for journal entries, so we try to keep our journal entries a little bit tidier by rounding numbers to the nearest dollar. Let's assume the bookstore uses the moving weighted average cost method with COG calculation. Here's the table for the financial accounting tech for purchases and sales once again. This time it's all nice and filled out. To demonstrate the moving weighted average cost method, let's assume the bookstore supplier increased the price of the textbook by $10 on September 10th. This increased the bookstore unit cost from $50 to $60. So, to illustrate that, I'll make a quick note here. Everything above this has a unit cost of 50, total of course, with shipping and insurance. And everything below this has a unit cost of 60. So there's going to be a transition point in the middle of the month. The weighted average is calculated after each purchase as follows. The total cost of inventory on hand is divided by the total number of units on hand, which will give us the average cost per unit. Whenever there's a change in what you buy something for, you perform this calculation to keep everything up to date. So, the next thing we will do to make life a little bit easier is we will add some columns to our table up here. I purposely kept it to the left so we have some room to work with. Now note that we already have quantity on hand, which is our denominator in the equation. So we have that already. It's taken care of. But we don't have total cost of inventory on hand. So I'll add another column here and label it total cost. And maybe I'll draw a line across like this and a line down. Doesn't have to be too neat, just as long as you can follow what you're doing. And then I'll add a final column, which will be called average cost per unit. So we're going to go through the process of figuring out a couple of things. The first being total cost of the inventory on hand, and second, average cost per unit. So it's going to be pretty straightforward. You're just going to follow this process and give it a shot, and we'll cover this at the start of the next video.